What are the drivers likely for markets in 2025? How contingent on rate cuts is that, particularly here in Australia? Will Hamilton from Hamilton Wealth Partners joins me now. Will, nice to see you again. Thanks for joining us. Maybe you can start by telling us what you're expecting sort of between now and end of December, because we've had such a wild ride. We've had such a run as of late, and valuations are looking pretty exy. Is a Santa Claus rally on the cards?
Yeah, look, we've seen, as you just mentioned, a very strong rally, and we actually think things are going to pause for a little while. We increased our Australian equity allocation in the middle of this year from underweight to neutral. We've been overweight developed market equities since basically October last year. But we felt that it's all down to interest rates, and but definitely Trump's given it a rise and gave things a bit of a further leg along. But it is, I think, the looking in the near term, the direction is all about, and will continue to be about interest rates, and on the back of that as well, inflation.
Yeah, okay. And so those will be the key themes to take us into 2025?
Correct. I think that where we're coming from, we think that you're going to get another 25 basis point decrease in US rates before the end of the year, and then probably 75 basis points next year. Australia, we don't think you're going to get a rate cut until, say May, June next year. But we need to look at things. It's all down to inflation. And I think that's the thing. So the risk actually next year is, whilst we were looking at another 100 basis points, we're now only looking at 75 basis points in the US, is if you don't get as much, those decreases to the extent that people have been envisaging. And that's because of some of the policies that come in. There's a lot of speculation as to what the new president's going to do, but at the end of the day, we won't know until he actually delivers. And will some of that be inflationary? And will that therefore curb the enthusiasm for further rate cuts?
Yeah, and so have you been making significant changes to portfolio positioning, to asset allocation on behalf of your clients with that in mind? Or is this a bit of a waiting game?
Yeah, it's a waiting game at the moment. We haven't, but we are looking at closely at what we do with equities. We've had a great run, unbelievable run. The second half of, the last quarter of 2023 was very good. 2024 has been fantastic. We've been overweight. And what do we do from this point in time? So we are looking very closely at that. To put Australia in perspective, we haven't liked Australia. We went to neutral because it had lagged, and we felt that there was so we went neutral really for the wrong reasons. We felt it had to catch up. And you haven't seen earnings growth being delivered in Australia, so it's really valuations which has pushed this market.
Yeah, and so is it more difficult to find those good new opportunities in the Australian market? Or once we get the lay of the land next year, post the US inauguration, once we see how China responds to any potential, early directives coming in terms of tariffs from the Trump government, do you think that there could be, where do you think the opportunities might emerge?
Yeah, we're not bearish, so don't get me wrong. I think that we are in an interest rate decreasing cycle. As long as we see inflation not rearing its ugly head again, we are optimistic, but it's not. It is going to be far. We've got to look for the opportunities and where they are. I've seen figures thrown out about Trump, and the increase in in tariffs, what that means for the price of an iPhone, for instance, versus a Samsung. And you hear we've had increases of around $230. Now they can't pass that on, so that therefore bites into their margin for Apple. So, we just need to see what's delivered and how the markets react. And despite the fact that the new president is saying tariffs aren't inflationary, bottom line is they are.
Yeah, and when you are thinking about asset allocation next year, this year was very much a hallmark of the year was this interest in private credit, in particular private markets. Is that a big focus for you there at Hamilton Wealth Partners?
Look, there's no doubt we've been involved in the private asset space for a decade more, but we've also been very sceptical as to, as a wealth manager, we could waste every hour of every day seeing somebody in the private asset space. So, there are liquidity constraints on portfolios, and you need to look at the overall quality of what the underlying funds are. So yes, they've been a great thing for portfolios, but we've been very selective and very fussy.
I
And
was speaking with somebody. Oh, go ahead.
We will continue to be.
Yeah, well, I was speaking with somebody just the other day who said that, look, 2025, well, he reckons that you might see some sort of a blow up with some of the private credit providers in Australia. Is that what you're on alert for?
But I think looking carefully and taking a conservative lens over it. The thing that we will not look at the single asset loans because you have 100% downside. And yes, you do need to make sure that you're positioned, I think, comfortably, and also liquidity is important. Make sure that the portfolio isn't overexposed to illiquid assets.